For Jim and Stop Trading.
There's a just fascinating piece by Morgan Stanley today. How is Amazon going to drive durable EBIT even as consumables surge? Now, this is very important. What this piece says is that those consumables that you're really kind of taking the place of going to a Walgreens, it's got low margin, 20%, versus the regular margin, 28%. So if you move up the consumables, you are going to have a not as good margin. What's interesting is, remember, in the big sell-off that we had, it was that Prime was not good. Retail was holding off. The selling. This doesn't even mention that. It's really about how people. There's a great, tremendous paragraph. It's a very well-run piece. Very well. Daily habits create behavior change. This is the existential threat to a Target this week. Why would you go to their food aisle? Why would you go to their consumables aisle, which is CVS, when you can just order the stuff and have it there? They do steer, obviously, to some versus others. But this piece is the first piece I've read, which is, wait a second, don't give up the ship just because they're doing the consumables. Don't worry. Longer term, the gross margins are going to be good. Right now, you can order chapstick and it comes, and they're losing money on that. But I think that don't bet against Andy Jassy for a way to be able to figure out how to do this profitably.
Imagine waking up to news that could very well send ripples throughout the stock market, potentially altering the investment horizon for many. Well, that's exactly what happened as Cathie Wood's ARK Invest made a monumental move, investing significantly in Amazon. Yes, you heard it right. Several of ARK's flagship funds, known for their bias towards speculative, high-growth companies, funneled a substantial amount of capital into this e-commerce behemoth. Although these actions are generating plenty of buzz, there's much more beneath the surface. What catalyzed this unexpected pivot? Why now? And what does it mean for investors? We'll dive into these questions and more, with names like ARK Innovation ETF and ARK FinTech Revolution ETF leading our narrative. But before we do it, if you want to keep up with Amazon's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates.
I was just thinking about the best Dow names of the year. You want to guess the best one? It's Walmart. Walmart is the number one Dow stock. And by the way, the last three earnings days have gapped up to all-time highs.
Well, Walmart has the only credible alternative to Amazon. And I think when you go out there, they'll admit they've got a really good program. And they give you a lot of specials, too. Walmart is so underrated. My daughter's going to Walmart today. Big candy run. That's what we do. We go to that stupid candy aisle, like with Dollar Tree. We do that.
Yes.
And I always say, go to Walmart. It's cheaper than the Dollar Tree, and it's better. I've said that to Doug McMillon. He laughs about it. But I love, my wife doesn't want to go to Walmart. My daughter says we ought to go to.
What's tonight, Jim?
Okay, I have Palo Alto. And this is very interesting. Palo Alto's got an extended collaboration to strengthen cybersecurity for the energy sector, SLB, but it's about earnings. And we told people from the investing club, because we have a position, this thing has been a rocket ship, maybe too much of a rocket ship. And we downgraded it just from the point of view that we bought a lot when it broke. We don't want to get people hung. There's CrowdStrike problems, but we also have a fiscal year issue. I just think don't get ahead of yourself. Some of these stocks have had big runs. Big.
Busy week ahead, Jim. We'll see you tonight.
Oh, man, is it busy.
Mad Money, 6 p.m. Eastern Time.
In an unexpected twist that has market analysts raising their eyebrows higher than a NASDAQ ticker at opening bell, Cathie Wood, the queen of high-stakes investments, has turned her market-gazed Midas touch towards Amazon. 5 out of ARK's 6 key funds broadened their portfolios with Amazon stock, an uncharacteristic pivot for a team typically hunting more speculative territory. This includes heavy hitters like the ARK Innovation ETF and the ARK FinTech Revolution ETF, both notable for their forward-thinking investment strategies. As for the rogue ARK Genomic Revolution ETF, let's just say its exclusion is quite expected given its rather different genomic aims. But what pushed Wood to make this pivot? And why now? Well, first off, Amazon's latest quarterly earnings reported on August 1st presented a mixed bag of financial intricacies. Amazon's sales ascended by 10%, hitting a substantial $148 billion, yet slightly falling short of the analyst estimate of $148.8 billion. Can we try to point out the irony here? A $0.8 billion shortfall is a miss in Amazon's language, a number larger than the GDP of many nations. Moreover, Amazon's adjusted EPS outperformed forecasts, reaching 126 compared to the expected 104, a substantial uptick from 65 cents last year. However, even stock market juggernauts have their Achilles heels, and Amazon is no exception. Enter Amazon's cloud offering, the venerated Amazon Web Services, which expanded by 19% to a grand $26.3 billion. This not only overhauled the $26 billion anticipated, but also sparked some celebratory tweets and analyst praises. As CEO Andy Jassy stated, "We're continuing to make progress, especially with AWS's growth." Indeed, this could be the understated reason behind Wood's investment conviction. AWS has been the sunbeam piercing through the cloudy forecast for Amazon, signaling that bolstered cloud growth is perhaps the golden ticket for investors. So could Amazon's strong performance in AWS and its expanding tech footprint be the key to smoothing out the turbulence in its e-commerce sector? And does this diversification explain Wood's surprising yet cautious investment in Amazon, marking a shift in her traditionally high-risk strategy? Let's find out. Hello, everyone, and welcome back to Investocracy.
Joining us now is Goldman Sachs tech analyst Eric Sheridan. He has kept his buy rating on Amazon, but lowered his price target to $230 a share from $250. I mean, we finished today, Eric, just below 168. Why do you feel confident that this is still a name to own right now?
Well, number one, thanks for having me on a Friday late in the afternoon. It's great to talk to both of you. Second, AWS is reaccelerating this theme around cloud computing as an output of the AI investments and hyperscalers seeing both putting cloud optimization in the rearview mirror, workload migration picking up at the enterprise level, as well as AI workloads starting to pick up and generate growth. We believe is still an underappreciated story. We don't think this is the end of the reacceleration growth story at AWS, and not only are you getting 19% growth, but you're also getting a mid-30s GAAP operating income margin at the same time, and we don't think AWS is valued as if it's a rule of 50 plus company inside Amazon as the first point. Second, while the consumer is becoming more volatile, and while there was a lot of noise around operating income this quarter, we would say the long-term thesis around a rising operating margin and Andy Jassy's commitment to delivering a mixture of a return to operating margins to pre-pandemic levels, as well as the advertising business contributing more margin than just that narrative, is still well intact. So we still see a pathway to GAAP earnings and operating income margins that look, believe it or not, relatively cheap on earnings as you look out over the next 2 to 3 years. We have a $6.50 GAAP earnings number for 2025, almost $8 in 2026 against less than $170 price today.
While Amazon's e-commerce front may be traveling through some turbulent air currents, its focus on global outreach, expanded service offerings, and improved logistical capabilities promises smoother sailing ahead. The essential takeaway is that Amazon is positioning itself as more than just an online store. It's emerging as a multifaceted tech giant with operational tentacles stretching into various sectors from cloud computing to logistics and beyond. Then comes the intriguing part. Analysts were astounded by Wood's deviation from her usual high-risk palette, marking Amazon now at a 0.17% weight across all ARK ETFs, clocking in as the 72nd largest holding. But is this deviation truly unfounded? A deeper delve hints at a strategic pivot focused on long-term reliability and diversified growth potential, precisely the traits Amazon exudes. Nonetheless, let's not gloss over Amazon's current market circumstance. Although Amazon shares have slipped by approximately 9% since its quarterly revelations, they've managed to cling to a 12% upturn year-to-date. When juxtaposed with the S&P 500 and NASDAQ 100, Amazon is dancing to a similar upward rhythm, thanks in part to its savvy operational refinement and expansive cloud capabilities. A sneak peek into Amazon's forecast hints at a promising Q3, projecting between $154 and $158.5 billion in sales, despite a small drag from foreign exchange rates. While this pricks the balloon of analysts' loftier $158.43 billion anticipation, It's worth mentioning that Amazon's sturdy fundamentals make it a fortress stock. The trailing PE ratio anchors at around 40x, drawing nearer to its 52-week low of 38.52x. For investors, this represents a strategic entry point given the company's ongoing market traction. And just when you think you've got Amazon all figured out, another layer surfaces. Consider the operational advancements Amazon is making not solely within the US, but also on a global scale. From infrastructural improvements to enhanced delivery mechanisms, these endeavors are set to sharpen Amazon's competitive edge. Thus, for Cathie Wood, betting on Amazon seems more than a strategic diversification. It's a calculated allegiance to a tech giant demonstrating substantial growth elixirs in both cloud services and e-commerce spheres. As long as Amazon can maintain its momentum in these areas, Wood's positioning might be not just justified but prophetic. So what does all of this mean for Amazon stock investors? The answer is easy, but first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Yeah, I mean, it's interesting when you lay out the thesis for Amazon, and you can argue that it's been similar for some of the other Mag 7 names that have reported in the past, call it week and a half, is investors have been really nitpicking and really going through line by line and honing in on very specific metrics, and that has been triggering the selling, even when there's been top and bottom line growth and growth in things like, in the case of Amazon, AWS, which is always typically the thing that drives the stock in one direction or the other. We were just having the conversation with Bob Elliott about stocks having an expectations issue right now. And I wonder how you see it, especially on a day where you have Elliott putting out a client letter saying NVIDIA's in quote-unquote bubble land and being skeptical of AI and calling it overhyped, with many applications not ready for prime time.
Yeah, I can't address the Elliott letter, but I think at the end of the day, what I would frame up for investors is, yes, there is a nervousness. There's certainly less patience for narratives to play out. I think there's elements of when can I get a return on some of the spend that's starting to work their way into my investor conversations, and we understand that narrative. You know, almost every technology and computing shift that I've been through ends up with moments of product innovation, followed by build cycles, followed by a little bit of disillusionment, and those play out over multi-year themes. So patience is running thin. There is not a lot of willingness to underwrite less linear narratives, and when you get a little bit of noise in something like an operating margin in Amazon, it does lead to a sell-off on a one-quarter view, but we would tell investors to zoom out a little bit and see the bigger picture that's of compounded revenue growth and compounded earnings growth that could play out here, irrespective of the AI theme at Amazon over the next 3 to 5 years.
So, where does this situate Amazon within a stock market landscaped by uncertainty, but buoyed by opportunity? Here's the crux. If you're looking for a stock with robust fundamentals, growth potential, and a potentially undervalued entry point, Amazon might just be the spotlight of your investment theater. As it stands, Amazon has shown remarkable resilience and dynamism, evident from both its annual returns and robust projections. Current analysis signals a bullish stretch for Amazon stocks, courtesy of its unyielding cloud domain growth and progressive endeavors in e-commerce. These attributes collectively set the stage for anticipated incremental gains, ensuring that Amazon remains a formidable player within the tech investment realm. What is your stance? Is Amazon's diversification prowess enough to command a steely segment of your investment portfolio? Do Cathie Wood's actions resonate with your investment philosophy? Let us navigate through these questions together. The market is more than just rising and falling numbers. It's a living, breathing entity brimming with stories and opportunities, some plain as day, others intricately woven beneath layers of speculative anticipation. So why not join the conversation? Your insights might just be the key that unlocks the next big market revelation. Dive in, discuss, and let the world know. What's your take on investing in Amazon? Finally, if you would like to know what companies like Amazon have been up to these past few days, go ahead and click on the next video on your screen. See you there.